Get grandfathered in. In this episode, we are going to address the question, can the government change the tax laws as it relates to max-funded IUL, Indexed Universal Life? So get ready. You're going to understand some very powerful things about the Constitution of the United States. So my name's Doug Andrew, and I've been a financial strategist and retirement planning specialist for more than 45 years. And I've been asked this question many, many times when I explain how max-funded indexed universal life, known as IUL, is sort of like a sacred cow in the Internal Revenue Code. Even before 1997, when indexing came out, it was just universal life, which was the brainchild of E.F. Hutton clear back in 1980. And so people would ask me, well, golly, Doug, this is pretty incredible, but can the government change the tax laws as it relates to these? And my answer is, well, yeah, the government can try to do anything they want. But let me share with you why I feel very safe that they will probably leave these alone, because they have looked at these many, many times, but also because of the grandfathering clause that is afforded in the Constitution. I think it comes under the ex post facto provision of the Constitution of the United States, where basically the government is not supposed to pass new laws that adversely affect something that you established under previous laws. Now, I can't guarantee that they won't touch the tax-free nature of indexed universal life or whole life insurance, but they've tried or considered it several times. And I'm going to share with you the last in-depth report that they put out, and I'm talking about the General Accountability Office, the House Ways, Senate and Finance Committees, when they look at, hey, we're hard up for tax revenue. So the tax revenuers often look at where the cash cows are. Where is the money that has been accumulated? Now, we know that they look at IRAs and 401ks as sort of a savings bond. It's the best savings bond the government ever came up with for themselves, because they have a permanent tax lien on your tax-deferred IRAs or 401ks. So naturally, a person would go, you mean if I put money into a max-funded IUL, it will accumulate tax-free? I can take it out tax-free. Yep, that's under Section 72E and 7702 of the Internal Revenue Code. It's been that way for over a century. Well, I know when you die, it's always been tax-free when it transfers in a death benefit. Yep. Well, could Congress pass a law to change that? Yes, but let me tell you what normally happens. Back in 1990, for example, the government was hard up for money. And so they did an extensive study. I remember reading the summary white paper. It was about this thick. It was published. And they basically came up with three conclusions, okay? First of all, when they studied the economics of it, it would be a short-term windfall if all of a sudden they taxed you on the inside buildup of cash inside your insurance policy, and heaven forbid if they taxed death benefits. That if you left behind $1 million of life insurance, your family would only get $600,000 or $700,000 of that. They realized they would be shooting themselves in the foot. In other words, when they did the analysis, any tax revenue they may get in the short run by taxing these, they would pay way more in the long run in additional Social Security or welfare benefits, or helping people who ran out of money in retirement, or people who left behind a widow, orphans, that they would be relying and going to the government for help sooner because they had taxed these insurance policies. So when they actually did an analysis, they realized that it would cost them money. It would be shooting themselves in the foot if they tax them. So they said, leave it alone. Wait till you hear the next two reasons why they said, leave it alone. So in this report, it became quite obvious that the insurance industry, a multi-trillion-dollar industry, the backbone of America, where governments go to for help, okay, that they're one of the strongest lobbies in the United States. So first of all, it would be very difficult to all of a sudden pass a law that would adversely affect people who are trying to be self-reliant, to set aside money for their future and not outlive their money, or if they happen to die or get disabled, that they would not be a drain on society by relying on the government to take care of them. And so the lobby is so strong, they go, you know what, this is an uphill battle to do this. But to be honest with you, there's a lot of politicians that own max-funded indexed universal life insurance or even whole life insurance, and they don't want to hurt themselves. It may be self-serving, but they use these. So why would they pass a law that adversely affects where they have their money, okay? And so they said, leave it alone. But here's the third reason. They said, if we ever did consider passing new laws, we would grandfather everybody who had established insurance policies prior to this law. And that's called grandfathering, because you don't have to comply with a new law. And there's already been a strong precedent set for this. So I'm going to give you an example of this with the ones that I've owned myself when new laws were passed. I didn't have to comply with the new laws. So, for example, when Universal Life was first introduced in 1980, brainchild of E.F. Hutton, and they weren't an insurance company. They were basically proponents of saving money, and they realized that a lot of people did not like the volatility of the stock market, and they didn't like being taxed sooner or later if it was a tax-deferred account like an IRA or 401k. And they said, hello, some of the strongest institutions in America and the world are the legal reserve insurance industry. And if you put money in them, and back in 1980, the general account portfolio interest rates that these companies were earning on their portfolios of AAA and AA bonds and mortgages on shopping malls and skyscrapers and so forth, they invest very little in stocks, but they're very conservative. But see, their average return was between 10 to 15%. In fact, from 1980 to 1990, I never earned less than 11.75% by having my money in the insurance contract. And so interest rates were high, but the insurance industry could pay you that kind of a return totally tax-free because it was insurance. And E.F. Hutton said, golly, we would have to be earning for our clients 15% or 16% in a tax-deferred IRA or 401k account in the market to net the same 10% after paying tax and fees. So they go, why don't we just bypass the volatility? Why don't we bypass the middleman and have people put money directly into the insurance companies where the banks and the credit unions invest some of their tier one assets for liquidity and safety, and let them earn 10, 11%. So I earned 11.75. Let's just round it down to 11. So from 1980 to 1990, if I earned 11, I netted 10. Only 1 percentage point of my earnings went out to the cost of the insurance, and that is what made it tax-free because it paid for the insurance that the IRS said had to be there, or it wouldn't qualify to be tax-free insurance under 3 sections of the code, 72E, 7702, and 101A. And so because of that, money inside the insurance contract would accumulate tax-free at great rates of return. Later on, when interest rates came down, then indexing came out, and you can then assign the interest you're earning, the 5% or 7% or whatever the insurance company is earning. You can take that interest and allow them to buy upside options, so when the market goes up, they can pay you 10 or 15%. But if the market goes down, those options expire worthless. You didn't make anything, but you didn't lose the principal you started out with. And you will average usually about 2.5% higher rates of return. And this is where I have averaged over 10% on my max funded IULs during that time period. The point is this: I took out my first ones clear back in 1980. Now in 1982, the TEFRA Act was passed. That's a tax citation. Tax Equity Fiscal Responsibility Act. Then in 84, the IRS didn't know what they were doing really, and so they had to clarify it 2 years later. That's the Deficit Reduction Act, that's DEFRA. Under TEFRA and DEFRA, it dictated the minimum amount of insurance you had to have in order for it to fall under the definition of tax-free insurance and not move over to another portion of the code, which is a taxable investment. I had insurance contracts before TEFRA and DEFRA. I didn't have to comply with TEFRA and DEFRA on those. Only on new ones thereafter. In 1988, the TAMRA law was passed. That's the Technical and Miscellaneous Revenue Act of 1988 that said you cannot fund it any faster than 5 years. If I wanted to put in $500,000, 500,000, like many of my clients did, they could only put in 100,000 a year for 5 years thereafter in order to have tax-free income the rest of their life. It took 5 years to grandfather themselves. Prior to TAMRA, you could put in the whole $500,000 in one fell swoop. So people who did that, they were grandfathered if they had their contract before TAMRA. The point is, it behooves you to get grandfathered. Because if Congress ever gets greedy and wants to mess around, you want to be grandfathered because you have an existing contract that even if you've been minimum funding, now you can make up for all that time you could have put in this much money and you only put in this much, but you're grandfathered because you established it prior to any tax law changes. Can I guarantee grandfathering? No. But the precedent has been set and we have a huge lobby, and I think that this will stay a sacred cow for the rest of my lifetime and hopefully yours too. So if you want to understand the answers to not only that question in more depth, but many of my subscribers to this channel get similar answers to similar questions, and you can also get answers by reading the book, The Laser Fund. It's my 11th book. It's actually 300 pages, 2 books in one. 200 pages contain charts, graphs, and explanations. 100 pages contain 62 actual client stories. I'll tell you what, I'll buy this book. The book's on me. I want to gift it to you. Go to laserfund.com and you pay $5.95 shipping and handling, and I'll send the book out to you absolutely free so that you can become empowered and get answers to some of these critical questions that will make a difference for your brighter future.